Picture a $6,000 line on a tax form that almost nobody fills in. It is brand new. It showed up for the 2025 tax year, and it belongs to you if you are 65 or older. Not a credit you have to chase. Not a loophole you need an accountant to unlock. A plain deduction sitting there, waiting. And for a married couple where both spouses are 65, the number doubles to $12,000. Here is the strange part. Most seniors who qualify have never heard of it. The money is real, the eligibility is wide, and the window runs from 2025 through 2028. Then it vanishes. Think about that for a second. A deduction this size, and the biggest obstacle standing between you and it is simply knowing that it exists. So let me ask you the uncomfortable question. What is a $6,000 deduction you never claim actually worth? The answer is nothing. It is worth exactly $0. A deduction only helps you when it lands on your return, and a deduction you never heard of never lands anywhere. That is the whole tragedy of this thing. The tax break is generous, the rules are not complicated, and yet the default outcome for a distracted or unaware filer is to leave every dollar of it on the table. Say your combined income puts you in a modest bracket. That $6,000 might trim a few hundred to $1,000 off your tax bill. For a couple, the $12,000 version can do more. Now stretch that across the 4 years it exists. The cost of not knowing starts to look like a real number, the kind of number people drive across town to save on a mattress. So stay with me to the end. I am going to walk you through exactly what this deduction is, who qualifies, and the quiet income limits that make it disappear. And the last piece, the reason almost nobody claims it, is the one that ties everything else together. It is not the tax code that fails these seniors. It is something smaller and more human than that. Get to the final act and you will see the whole pattern. Let's be honest about how tax breaks usually work. They are buried conditional and wrapped in enough fine print to make you give up. This one is different, and that difference is worth understanding line by line. Here is what it is. Starting with the 2025 tax year. There is an additional deduction of $6,000 for each individual who is 65 or older. That comes from the One Big Beautiful Bill Act, the large tax and spending law signed in July of 2025. The IRS confirmed the details in a newsroom notice dated February 27, 2026. So this is not a rumor circulating in a retirement forum. It is a written provision with an agency explaining how to use it. The $6,000 is per person. If you are single and 65, you get one. If you are married and both of you are 65 or older, you each get one, and the household total climbs to $12,000. Think of it like a second helping added on top of the plate you already have. You did not have to trade anything away to get it. It simply stacks. And that stacking is the part people underestimate. Here is what almost nobody tells you about this deduction. It works whether you take the standard deduction or you itemize. Most special deductions force a choice. You go one road or the other, and you lose whatever was sitting on the road you did not take. Not this one. It rides along either way. If you take the standard deduction, this $6,000 sits on top of it. If you itemize your mortgage interest and charitable gifts and medical costs, it sits on top of that instead. It is a bonus lane that never closes, no matter which highway you are driving. Picture two seniors who file completely differently. One keeps it simple and takes the standard deduction. The other has a stack of receipts and itemizes everything. Both of them still get the $6,000. That is unusual, and it is the reason this provision is quietly more valuable than it first appears. There is no catch hiding in the choice of how you file. The catch, if there is one, hides somewhere else. And we will get to exactly where. Notice the timeline, because the timeline is the whole personality of this deduction. It exists for tax years 2025, 2020, 2027, and 2028. That is it. 4 years, then the door closes. This is a temporary provision written to expire after 2028 unless a future Congress decides to extend it. So the urgency here is not a marketing trick. It is baked into the law itself. You have a defined window, and every year inside that window that you fail to claim is a year you do not get back. Compare that to most of the tax code, which just sits there year after year, indexed and predictable. This one has a countdown clock attached. Treat it like a coupon with an expiration date printed on the corner, because functionally that is what it is. The difference is that a coupon saves you $3 on toothpaste, and this saves some households a four-figure sum across its life. Same expiration logic, very different stakes. Which raises the obvious question. If it is this good, who actually gets to use it? Now we come to who qualifies, and here the rules are refreshingly plain, right up until the income limits arrive. Start with age. You must be 65 by the end of the tax year. Not 65 for the whole year. Just 65 by December 31. So if you turn 65 at any point during the year, even on the last day, you are in. The tax code treats you as having reached the threshold, and the deduction becomes available. Next, you need a valid Social Security number. This is a normal requirement for a benefit like this, and most seniors clear it without thinking. Then there is one more gate. You cannot be claimed as a dependent on someone else's return. If your adult child claims you as a dependent, the deduction does not flow to you. For the vast majority of retirees living independently, this is a non-issue. But it is worth knowing because family tax situations get tangled, and a well-meaning arrangement can quietly cost you the deduction. One more structural rule for couples. If you are married, you generally have to file jointly to claim it. Filing separately is the road that closes this lane. For most married retirees, joint filing is already the default and the cheaper option anyway, so this rarely stings. But if you and your spouse file separately for some particular reason, this deduction is one more thing to weigh against that choice. Small rule, real consequence. So far, so simple. Age 65 valid Social Security number, not a dependent married couples filed jointly. If that were the whole story, nearly every senior in the country would claim it, and we would not be calling it the deduction almost nobody claims. But there is an income test layered on top, and the income test is where the quiet part lives. Here is how the phase-out works. The full deduction is available up to a modified adjusted gross income of $75,000. If you are single, or $150,000 if you are married filing jointly. Below those lines, you get the whole thing. Above them, the deduction starts to shrink. It does not vanish all at once. It fades at a rate of 6% of every dollar of income above the threshold. So the more you earn past the line, the smaller your deduction gets, dollar by dollar. Follow that fade all the way down, and you hit the point where it reaches zero. For a single filer, the deduction is completely gone once your income reaches $175,000. For a married couple filing jointly, it is gone at $250,000. Between the start of the phase-out and that endpoint, you are in a shrinking zone, getting some of the deduction but not all of it. Picture a ramp, not a cliff. You do not fall off the edge. You walk down a slope until there is nothing left underneath you. This 6% phase-out is the part that catches people off guard, and it is worth sitting with, say. You are a single filer with income a little above $75,000. You still get most of the deduction, just not the full $6,000. Many seniors in that range assume that being over the line means they get nothing, so they never even look. That assumption costs them. The ramp means partial eligibility is real eligibility. A shrunken deduction is still a deduction, and it is still worth more than the zero you get by not claiming. Think about who lives in that middle zone. A retired couple with a pension, some investment income, and their Social Security might land somewhere between $150,000 and $250,000 of modified income. They are not wealthy by the standards of the tax code. They are comfortable, and they are exactly the people most likely to shrug and assume a senior tax break was not written for them. The phase-out was designed to aim this at lower and middle income seniors, but the design also means the people on the ramp have to do a little math to see what they still qualify for. Most never run that math. And here is the mechanical detail that makes the phase-out so easy to miss. It happens silently. There is no letter in the mail telling you that you crossed a threshold. There is no alert. The deduction simply gets smaller as your income rises, And if you never knew to claim it in the first place, you never noticed the fade at all. A benefit that shrinks quietly and disappears quietly is a benefit almost engineered to be overlooked, which brings us to the real question. Why does almost nobody claim it? This is the heart of it. Not the mechanics, the psychology. There are 4 reasons this deduction slips through the cracks, and none of them is that the deduction is hard. It's not one thing. It is a stack of small ordinary failures that add up to a lot of unclaimed money. The first reason is that it is new. Tax habits are sticky. You file the way you filed last year and the year before that because the form looks familiar, and familiarity feels safe. A brand new line item introduced for the 2025 tax year has to fight against decades of muscle memory. Most people do not read the tax code for fun. They do their return, they get it over with, and they do not go hunting for provisions that did not exist 12 months ago. New things get missed simply because they are new. The second reason is that it is buried. This deduction did not arrive as a standalone headline. It came inside the One Big Beautiful Bill Act, a sprawling piece of legislation packed with dozens of provisions competing for attention. When a tax break rides inside a giant bill, it gets drowned out by everything around it. The big-ticket items get the news coverage, a $6,000 senior deduction, meaningful as it is to the people it helps is a small paragraph in an enormous document. It is easy to lose a single valuable sentence inside a book that thick. The third reason is that it is easy to miss on the actual return. Even people who use tax software can overlook it, especially in this first filing season, when the prompts and the guidance are all new. If you do not know to look for it, you may breeze right past the screen. That would have captured it. The software is only as smart as the questions you answer, and if you never signal that you are 65 and eligible, the deduction may never surface. First seasons are messy. This is a first season. The fourth reason is the phase out we just walked through. Because it fades silently, plenty of seniors who would get a partial deduction assume they get. None they hear there is an income limit, they know they earn a decent income, and they mentally disqualify themselves without checking the ramp. The quiet phase out does double damage. It reduces the deduction for higher earners, and it scares off middle earners who never realize they still qualify for part of it. Now stack those 4 together. New buried, easy to overlook on the form, and quietly phased out, any one of them would cause some people to miss it. All 4 at once explain why a genuinely generous deduction goes unclaimed by so many of the people it was written for. It is not that the tax code is cruel here. It is that the deduction is quiet, and quiet things get missed. There is one more layer, and it is the one most likely to confuse you. This deduction interacts with the way Social Security is taxed, and the interaction is subtle. You may have heard this provision described as delivering on the promise of no tax on Social Security. That framing is where a lot of confusion comes from, so let me untangle it carefully. Here is what is actually true. Your Social Security benefits are taxed based on something called provisional income. That is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. Once that combined number crosses certain thresholds up to 85% of your benefits, can become taxable. For a single filer, the taxable portion starts climbing above $25,000 of provisional income and can reach the 85% tier above $34,000. For a married couple, those lines sit at $32,000 and $44,000. Those thresholds have not moved in decades. They are frozen. The new $6,000 deduction does not repeal any of that. The provisional income rules still exist exactly as they did before. What the deduction does is lower your taxable income. And for some lower and middle income seniors, lowering taxable income is enough to erase the tax they would have owed on their benefits in the first place. So the benefits are not made legally tax-free. The math just works out for some people so that they end up owing nothing. Those are 2 different things that feel like the same thing. Think about that for a second. The rules did not change. The outcome changed for certain households, and only for them. This distinction matters because it protects you from a costly assumption. If you believe your Social Security is now simply tax-free, you might stop paying attention to your provisional income entirely. But the frozen thresholds are still there, still doing their work in the background. The deduction is a shield against some of that tax, not a repeal of it. Understanding the difference is what keeps you from being surprised at tax time. And it sets up the honest part of this story. So let me be straight with you about the limits of this thing, because a video that only sells the upside is not doing you any favors. This deduction is temporary. It is written to expire after 2028. Unless a future Congress extends it, the 2028 tax year is the last one where it exists, so do not build a permanent retirement plan around a 4-year provision. Use it while it is here and assume it may not be here after that. It also does very little for high earners. If you are a single filer above $175,000 or a couple above $250,000, you get nothing at all, and everyone on the ramp between the start and the end of the phase-out gets a reduced amount, not the full deduction. This was aimed at lower and middle income seniors on purpose. If your income is high, this is not your break, and no amount of clever filing changes that. And to say it one more time, because it is the most common misunderstanding out there, this does not literally make Social Security tax-free. It is a deduction against taxable income. For some people, it wipes out the tax they would have owed on their benefits. For others, it just softens the blow. The provisional income rules survive intact. Anyone who tells you your benefits are now untouchable is skipping the fine print, and the fine print is where the truth lives. Knowing the real shape of the benefit is worth more than believing a cleaner version of it. So here is the twist, the thing this whole story has been circling. The biggest tax breaks in your life are almost never the ones someone hands you. They are the ones nobody tells you to take. The tax system does not chase you down to make sure you claimed everything you were owed. It processes what you put on the form. Whatever you leave off, it quietly keeps. That is not a conspiracy. It is just how the machine runs. The burden of knowing sits with you. And that is the real reason the $6,000 deduction goes unclaimed. Not because it is hard, because a benefit you do not know about might as well not exist. Here is the line worth remembering. A deduction you never claim is worth exactly zero, no matter how generous it looks on paper. The generosity is irrelevant if the knowledge is missing. Value on a page is not value in your pocket until you reach out and take it. Once you see that pattern, you start seeing it everywhere. The frozen Social Security thresholds that quietly tax more of your benefits each year. The deductions buried in bills too big for anyone to read. The credits that expire before most people learn they existed. None of these are hidden by some villain. They are hidden by scale and by silence, and the only real defense is attention. The people who come out ahead in the tax code are rarely the ones with the best accountants. They are the ones who bothered to find out what was already theirs. This deduction is just the clearest example of that this year. So let me leave you with two seniors. Same age, same income, both 66, both eligible for the full $6,000. The first one hears about the deduction, checks the box, and watches a few $100s stay in her account instead of leaving it. The second one never hears a word about it. She files the way she always has, the form looks familiar, and she moves on with her life. At tax time, one of them is a little richer than the other, and neither of them feels any different. That is the quiet cruelty of it. The gap between them is not effort or income or luck. It is a single line on a form that one of them knew to fill in. Remember that $6,000 line we started with, the one almost nobody fills in? Now you are the one who knows it is there. If this helped, share it with someone over 65, give it a like, and subscribe for more of the money the tax code forgets to mention.